Greetings of the day and welcome to IBI India Business Insights. With the union budget being announced for this session, there are a lot of questions in the mind of the people. India Business Insights has been trying to keep you all updated. We all have recently put up a video on the direct and indirect taxes, the link for which you will find in our description box. And before we go ahead with today, please like and share this video and please subscribe to India Business Insights. So today we will be dealing with one such topic, that is the old and the new tax regime, and when should people go ahead or with which tax regime, and when should people remain in the old regime. We will be discussing that today. So once again, we have with us today Mr. Pushpendra Surana. He is a leading chartered accountant and a partner of the GMS and Associates. He is an insolvency expert and a deep expertise in direct and indirect taxes. We welcome you, sir.
Thank you so much, Disha.
Along with him, we also have Mr. Naman Agarwal today. He is a qualified chartered accountant and he is a business analyst from India Business Insights.
Thank you, Disha.
So, sir, we will be beginning with the changes that have been brought in the new tax regime, and please, you may begin about that.
So, Disha, this budget has brought a lot of changes, and it says government is inclined to adopt the new regime of tax, which was launched 2 years back. So the new regime offers that the slab rate, which was earlier at 2.5 lakhs, when there was nil tax, which has been increased now to 3 lakhs. So 3 to 6, the percentage has been fixed at 5%, and then from 6 to 9 it's 10, 9 to 12 is 15, 12 to 15 is 20, above 15 it's 30%. Against that, the old regime, there has been no change. The deductions have been retained, the exemptions have been retained. The old regime still, I would say, is beneficial as compared to the new tax regime. Against that, and going forward, I would just like to add a list of few exemptions which are still available in the new tax regime, while it is not allowed in the old tax regime retains the exemptions, while the new tax regime doesn't. So first is the leave travel allowance. Second is the housing allowance. Both of them are actually a very imbibed in the salary structure of any of a salaried person. Then there is standard deduction, which is available only to salary. Now the new tax regime also offers the standard deduction. Then you have deduction on interest under section 80 TTA and TTB. There is a entertainment allowance deduction, education allowance deduction. Tax relief was available on interest paid on home loan for self-occupied or vacant property. And there was a deduction on family pension. There was deduction under section 80D for mediclaim or medical expenses. Then you had other sections. You had section 80G or 80GG, which was available which is available in old regime. So these are the deductions or exemption which are not being offered in the new tax regime. New tax regime offers only one deduction, which is standard deduction of 50,000 and a 2,500 professional tax deduction. Apart from that, there is no tax deduction. How has been the new tax regime being adopted, and what benefit and it offers, and to whom? Basically, this new tax regime is very attractive to people who wants more money in hand, who have the habit of consuming, spending more and consuming. As our Honorable Finance Minister has said, that people who are drawing or who are actually earning income up to 7.5 lakh rupees, they will not be required to pay any tax, or people with a income of 9.5 lakh rupees, they'll be only paying 45,000 as tax, which is only 5% of the total income. So people who were earlier of that phenomena that yes, the saving is good for future. So for them, the old tax regime is of favor, is of flavor, I would say, because under that still the government supports for 80D, 80C, or I would say 80G. Then you have house rent allowance. So all those deductions gives a person a handsome money in pocket in terms of tax savings, and that also is a inclination for anyone to go for buying a property with a home loan, or invest in insurance, mutual fund, or have a mediclaim, or give a donation to various kind of NGOs or help others. So those are the things which over the years India has been known for, and India has been doing. The new tax regime is a sea change, and going forward, if government stays with it, then people have to make their mindset accordingly and be more spendthrift than be more saving friendly.
The TDS rate, which was about 50 lakh on withdrawal, whose limit was 50 lakh or 1 crore on withdrawal, was increased to 3 crore for cooperative societies. Can
Correct.
you elaborate the purpose for doing that?
Basically, see, in cooperative, there is a lot of cash movement, there is a lot of cash deposits. So, being a self-help society, being a society where people actually generate cash, they save in cash, and that cash, if it is not coming to the system, and there is a TDS deduction, that actually is a what you call is a demotivator for a small person, for a person who is part of a member of the cooperative. So government has rightly taken a good step in this direction, and so that people don't have to be bothered that no, my deduction will be more, so I have to claim that deduction. I have to go through that hassle of filing the return. So that also hampers the government. The government policy, the government intent was not that, but somehow the limit being short, so that is the reason why it was increased to 3 crores.
Okay, thank you so much, sir.
And
Then
in,
my
in,
next,
in the same context, if you see there is another TDS which has been increased in that is in terms of outflow of foreign currency. So there was a scheme which was introduced, I think, 2 years back by the government, wherein there was remittance, and you need to
yes,
deduct TDS at the rate of 5% or 0.5%, depending
yes,
upon the activity. So which has now been increased. So which also is of very prominent thing, because people who are going abroad or studying abroad or traveling or doing business. So for them, that is a very important thing. You have to plan accordingly, because that will be a huge cash outflow.
yes,
So because if you want to travel for business purposes or for leisure, the threshold has been removed, and the rate of TDS has been increased from 5% to 20%.
yes,
So that in any which ways, if you are doing it because the person to whom you're paying the money in terms of foreign currency, if that is not having any TDS, so then that TDS you have to bear it from your own pocket. And later on, it won't be a TDS, it is a TCS, and later on you have to claim it. So that way, it again is a big dent to the cash flows. So I would advise people should plan accordingly.
Okay. Then my next question is regarding the startups, relief given to startups. It was said that 51% of that if the shareholder continues to be 51% of the shares, then they would be allowed to set off their brought forward losses. So what
Correct.
is the relief given in that section?
So in that section, earlier the brought forward losses could be carried for 7 years. The same has been increased, and now you can carry forward the losses for another 10 for next 10 years.
Okay. So what is the difference between the startup and two other?
So for others, the carry forward losses remains the same. It is a 7-year concept wherein you can carry forward all your business losses and depreciation. There is a different the carry forward of business loss and depreciation are two different things. Whereas in depreciation you can carry forward for n number of years, while the business loss has to be consumed in a period of 7 years. If it is not, then it is lapsed. While
Okay.
for the startup, it is a big relief because the initial years there are losses, and then for say after 7 or 10 years, people start earning money, they start earning profit. So if that is available to them, like say a startup which started in 2022 and it has incurred losses for 5 years. Now after 5 years, the profit in next 5 years are equivalent to what the losses have been. So that way, the losses can be set off against the next 5 years profit in a span of 10 years. So
Yes.
that again will be a big relief.
Okay. I would like to ask, sir, if the 51% shareholders need to continue in the big company. Is it for every type of company or every type of corporates, or is it something else for some other company?
See, the provision of section 73 to 79 is categorical on this, wherein you have to be in the company as a major shareholder to enjoy the brought forward losses benefit. If there is any change in the shareholding, then government is always keeping an eye on it. And if there is a major change in the management, because see, these are the things which people do for tax planning. Like there is a company which is having profit and there is a company which is having a loss. So by merging both the companies and the profit-making company taking over that company and being major shareholder, so that way there is a huge loss to the revenue. So to plug in those losses, government had come up with this idea that if the shareholders continue to be with the company for next 3 years, after reducing their stake to 51%, and still if they continue, then the real intent comes out that yes, there is a business which is going on. This is not just a sham transaction. So government also understand that for some reasons there are activities which need to be done. There are some tax planning which needs to be done, but just for the sake of doing a sham transaction to save on taxes or to window dress, so that the government doesn't allow. And this budget, not only this budget has tried to plug in so many loopholes which have been there. I'd like to add one more in this if we have time. Disha, if you have time.
Yes.
Okay, thanks. So I would like to add one more thing in this. When we're talking about the sale of property, the interest on housing loan, it was allowed as deduction under section 24B. And also that interest was being capitalized, shown as improvement. And when one person was selling this property, that was taken as improvement of asset, and accordingly the capital gain impact was reduced. So from 1st April 2023, the government, this budget states that if there is any such transaction, no such addition of interest will be allowed to be capitalized if that has been taken as a deduction for computing income. So so this in a way is good for new regime people, wherein they're not claiming any deduction, but at the same time, then they can put that as an addition, claim as improvement in property, and at the time of capital gain, they can actually take the benefit. While for the old tax regime people, they can claim the deduction in the year in which the interest has been expensed, but they will not be able to now take that as an improvement of property. So that this also is an important point for the old and new regime difference.
So my next question is regarding the TDS under 194 LBA. Can you explain that point?
So it is on the distribution of dividend being earned by companies who are covered under or entities who are covered under Section 1023 FC and FCA. So the rate, which was earlier 7.5%, it has been increased to 10%. That's the first thing which is a change. And basically, it's a business trust, which I would say it is the RIET to which it relates, wherein the real estate entities are being conferred to form REITs, and their income were exempt to a certain extent. There were certain tax holidays, and then when it was seen by the government, then that these income can be taxed in certain formats, then this section was introduced in 2020. So the units of certain business trust which can be distributed to its members. So whenever there is a distribution of income or in form of dividend, so that there is a TDS which is being levied on such distribution. And that distribution, that distribution can happen to a resident or a non-resident. So the tax rate are different for residents and for non-residents. And then similarly, both the section of FC and FCA, they have similar treatment. So do you have?
So what about the changes in the LICs? Some limits have been changed, I think. LIC, life insurance policies.
See, the life insurance policy, there as such, there are two changes. One is the non-allowance of 80C under the new tax regime. So that is so that benefit is not available to anyone who applies the new tax regime. The second is whenever there is a policy of more than 5 lakh rupees, if you are taking policy where the premium is more than 5 lakh rupees, then in that case, whenever there is a maturity, whatever the money that you're receiving, that will be coming as a taxable income in your hands. So this is a biggest change which this budget has brought in.
So my last question I would like to ask, it was in F4 point. It is written as sometimes tax for income of an earlier years is deducted later, while tax thereon has already been paid in the earlier years. Amendment is proposed to facilitate such taxpayers to claim credit of this TDS in the earlier year. Can you give me some examples where it is done?
I tell you. Whenever you this is in relation to section 43B, wherein like I would there is an outstanding in statutory taxation which has not been paid, like PFESI, or the section that you are talking about is an expense. So I'll cover the first one and then I'll come to the next one. So 43B was there that whenever you are paying the statutory taxes, you will be allowed to get the benefit in that year only. Like there is an outstanding of GST as on 31st March, and you have paid that money before filing of return. So that money, that deduction was available in the year to which you are filing the return for. And if you pay that money after the after the due date of filing the tax return, then the year in which you have paid the money, so you are allowed to claim the deduction. So this pertains to section 43B. The second one is the TDS, wherein section 40A, wherein you had to deduct TDS on like I would say professionals. You have paid some money to a professional, but you are not deducting tax. So in that, or you're not deposited tax. So in that case, 20% of your expense was disallowed. So 30% of your expense was disallowed. And in the year in which you deposit or you pay the TDS, the expense was allowed in that year. But now, since the revision has been limited, earlier you were allowed to revise your return. Now the revision has been limited. So in your revised return, if you want, you can revise the return and claim the TDS, that this TDS has been paid in this year and that expense can be allowed in that year itself to which that expense pertains to.
Okay. So will that increase the misguidance or compliance? Means people not following the compliance in if they are get benefited in that year only. So they will pay the tax later.
See, why this provision has been made, it is for the rectification of any of your mistake which happened in that assessment year wherein you could not pay.
Yes.
Instead of we going into that, this was being deliberately done. Government has allowed that if this is a mistake, if it's a genuine mistake due to hardship, so you can claim that benefit, and instead of you being forced to pay tax on that, you pay the tax. You are absolved of the interest or the penalty, not the interest but the penalties. So you save a lot of penalties, and the government is saved a lot of hassles on assessment. So it can be a win-win for both the assessee and the government.
Thank you,
hope
sir.
that the questions that were in the mind of a lot of our viewers has also been answered today. So if you all have any other questions yet to be answered, please write your questions in the comment section. Thank you so much, sir, for joining us today, and we hope you have a lovely evening.
Right. Thank you. Same to you.
Thank you so much. Thank you.
Right. Bye.
Bye, sir.